Welcome to the debate. So imagine a scenario where just a single mistyped tax code in your company's software doesn't just result in some financial penalty at the end of the year, it actually immediately locks the doors of your warehouse today.
Right, the shipping manifest literally won't print.
Exactly. The truck is stuck at the dock, and your customer, well, they just don't get their product.
And I mean, that is not a hypothetical scenario. That is the actual operational reality in dozens of countries right this second.
Which represents just this staggering departure from how we've historically viewed corporate tax compliance. We used to rely on these metaphors of archaeology. For decades, the tax department was basically digging through the past.
Oh, entirely. You had boxes of receipts, retrospective audits.
Right, historical data. A transaction happened, and then months later, the tax team was essentially trying to reconstruct the reality of that commercial event just to ensure the organization paid its dues.
Yeah, looking in the rearview mirror, basically hoping you hadn't missed a massive pothole like 3 miles back. I mean, the stakes were financial, sure, but they were delayed.
But today, because of the emergence of continuous transaction controls or CTCs across, more than 100 countries now, that rearview mirror is gone. The government is no longer looking at your history. They are standing right there inside the digital cash register.
It's a totally different ballgame.
It really is. We are dealing with global, real-time reporting standards. And because of this profound shift, the global head of indirect tax has a completely new mandate. The role has fundamentally transformed, yet ironically, the corporate job description hasn't even begun to catch up.
No, not at all. The ground has completely shifted beneath the function. We are operating in a transaction blocking environment now.
Which brings us to the core tension we are exploring today, based on the shifting landscape in our source material. So what is the paramount value of this newly evolved global head of indirect tax? From my perspective, the ultimate evolution of this role is extracting offensive value.
Offensive value.
The tax leader must become an intelligence generator. They need to turn regulatory data into strategic fuel for the CFO, the Treasury Department, and the supply chain.
Well, I see a much different reality on the ground. The fundamental shift here is it's not about offensive data mining. It is structural and defensive. The modern tax leader must act as an embedded architecture sponsor and a governance authority.
But isn't that just keeping the lights on?
No, because in a real-time compliance world, indirect tax operates at the exact speed of business. It determines whether a commercial transaction can legally occur at all. If the technological architecture is flawed, the business simply stops trading.
Okay, but let's examine what a real-time compliance world actually produces. The traditional framing of tax as a cost center that merely, calculates liabilities to prevent penalties, that's radically incomplete now. Think about the data set we were talking about here.
I know the data set you mean, but...
Just hear me out. When governments mandate CTCs, they force companies to generate the single richest strategic data set in the entire enterprise. It is a continuous, mathematically validated, transaction-level record of global commercial activity. Every purchase, every sale, every intercompany transfer is documented, formatted, and verified in real time.
Verified by a sovereign tax authority's servers before the transaction is even finalized, which is my whole point.
Right, yes, and consider what most multinational companies do with this incredible corporate asset. They package it up, they file it with the tax authority to meet the legal mandate, and then they essentially just discard it. They dump it into a regulatory black hole.
Well, they dump it because they're busy trying to keep the systems running.
But that is a tragedy of missed potential. The highest value of the global head of indirect tax is repositioning their entire function to utilize this data. When you siphon this data effectively, you can optimize VAT cash flows. You can manage net refund positions to drastically improve working capital.
If the data is right.
Exactly. And you can identify supply chain risks before they metastasize. The tax leader should be an offensive player leveraging a data set that honestly nobody else in the C-suite possesses.
I understand the appeal of that vision, I really do. But strategic intelligence is merely a secondary byproduct of a much more urgent existential mandate. The core of my position is architectural. Let's look at the actual mechanics of a continuous transaction control.
Sure, let's get into the mechanics.
Okay, under a CTC framework in a country like, say, Brazil or Italy, a tax authority validates an invoice before it reaches a customer. Tax is no longer reviewing historical ledgers. Tax is participating in a live operational process. As you said in your opening, if the invoice doesn't clear the government portal, you literally don't make the sale.
The commercial stakes are instantaneous. I completely agree.
Immediate and uncompromising, which is exactly why the global head of indirect tax is now explicitly an architecture sponsor. If this tax leader does not sit in ERP migration design sessions, if they aren't specifying the logic for the data orchestration layer,
Wait, but are they IT or are they tax?
they have to be the bridge. If they aren't aggressively governing the complex ecosystem of external vendors, the compliance architecture will fail. It might be technically implemented by the IT department, sure, but it will be substantively flawed from a tax perspective.
That's an interesting point, though. I would frame it differently. I view that structural integrity as the prerequisite, not the ultimate goal.
A pretty massive prerequisite.
Fair. But think about it this way. Building a highly sophisticated pipeline to the government is legally necessary. You have to build the pipe to keep the business running. But if you're just pumping that validated data straight into the ocean, instead of, installing valves to siphon it off and irrigate your own crops, you've completely missed the point.
I don't think they're missing the point. They're just trying not to drown.
Building the linear flow from the ERP through the compliance platform to the tax authority is what average companies do. The true transformation happens when the global head of tax engineers a secondary pipeline from that compliance layer back into the company's analytical environments to actually empower the CFO.
I come at it from a different way. You're talking about irrigating crops and installing valves, but I'm talking about the primary pipe bursting under the sheer pressure of operational reality.
Bursting? Isn't that a bit dramatic?
Not at all. Without flawless logic governance, that data you want to analyze so badly either doesn't get generated in the first place, or it's fatally corrupted.
I'm not convinced by that line of reasoning, because honestly, you're treating the architectural foundation as if it requires 100% of the strategic bandwidth. If IT and your external software vendors are maintaining the pipes, shouldn't the tax leader be focused on the output?
But IT cannot maintain the pipes without the tax leader dictating the blueprints. IT does not understand tax law. Let's talk about the mechanics of the data orchestration layer I mentioned earlier.
Okay.
An orchestration layer is essentially the digital traffic cop, sitting between a company's internal financial systems and the outside world. It takes the messy, raw data from your company's billing system and translates it into the highly specific, structured XML format that a foreign government demands.
Right, it translates the internal gibberish into actual regulatory compliance.
Precisely. But here is the catch. The rules dictating that translation change constantly. When a tax authority introduces, say, a new mandatory data field or updates a tax rate, the question isn't just some abstract, what does the law say?
Right, it's practical.
The question is, does our automated systems code accurately map that new legal requirement to the correct field in our ERP by midnight tonight? That is logic governance. Ensuring the system accurately executes these ever-changing technical requirements is an incredibly heavy lift, and it goes beyond logic into performance governance.
Meaning the actual uptime of the system?
Uptime, acceptance rates, rejection patterns. If a government server in Italy kicks back an invoice, the system needs to know why. Was the customer's VAT ID formatted wrong? Did the tax calculation round to the wrong decimal?
Minor errors with massive consequences.
Exactly. If you aren't governing this technology layer, the business grinds to a halt. The warehouse software literally won't generate the digital clearance code required to release the inventory. You cannot optimize working capital if your invoices are being systematically rejected in real time.
Look, I understand we need the plumbing to work, obviously, but let's look at the actual evidence from our source material regarding what happens when that plumbing does work and what that data actually contains. Let's look at why an invoice might get rejected.
Okay.
CTC frameworks don't just validate your internal math. They validate the counterparty registration status for every single invoice submitted.
Right. They ping the government database to check if your supplier or buyer is currently in good standing.
Exactly, the mechanism I'm talking about. Now consider the real-world implications of that. Suppose your automated system flags that an invoice from a critical supplier in Germany was rejected because their VAT ID was suspended by the government.
A red flag, sure.
That is not just a tax error to be patched. That is a blazing early warning indicator of profound business distress. That supplier might be facing insolvency, or they might be locked in a massive regulatory dispute.
They are legally compromised, yes.
And if they are legally compromised, they might be about to fail to deliver critical manufacturing components to your assembly line next week. If the tax leader is just sitting in the basement managing logic governance, they fix the technical error, grumble about the supplier, and move on.
Hey, the basement is where the servers are. Somebody has to watch them.
But an intelligence-generating tax leader routes those health signals directly to the procurement and supply chain teams. They identify supplier risk weeks or months before actual supply chain disruptions occur. They move the tax function out of its historical silo and directly into operational risk management.
That's a compelling argument, but have you considered the sheer technical complexity of maintaining the capability to generate those signals consistently? You're assuming the infrastructure just seamlessly hums in the background. You're completely ignoring vendor and partner governance.
I'm not ignoring it. I'm just looking past it.
But you can't. The global indirect tax ecosystem isn't a single piece of software you just buy off the shelf. It is a sprawling, fragmented web of technology providers, local compliance partners, and government-certified APIs.
It requires managing a vendor ecosystem, certainly.
A highly volatile one. The tax leader is entirely responsible for evaluating these vendor architectures against actual on-the-ground regulations. Let me give you a tangible example.
Go ahead.
You might have a software vendor selling you a global compliance solution with what they call a seamless API connection. It looks great in the aspirational sales brochure.
They always do.
Right? But an API is just a digital bridge. If the local government in Poland updates their strict XML schema overnight, which, by the way, they frequently do, and your vendor's API isn't agile enough to map that change by 8 a.m., that bridge collapses.
And the Polish operations are legally paralyzed.
Paralyzed. The global head of tax has to distinguish genuine architectural coverage from a vendor's sales pitch. They have to govern service-level agreements, mandate testing environments, audit the vendor's update cycles.
Sure, it's work.
If they aren't meticulously governing that fragmented ecosystem, those brilliant supply chain signals you want to send to procurement, they're going to be completely obscured by false positives, or the system will simply crash. The foundation has to be governed flawlessly.
I concede the ecosystem is volatile. I do. But let's look at where the true organizational influence lies when you lift your head above the daily operational fires. Let's talk about the regulatory anticipation mandate.
Okay, let's talk about it.
The global indirect tax landscape is in a period of accelerating change. We aren't just dealing with local e-invoicing. We are dealing with massive OECD initiatives like cross-jurisdictional digital reporting requirements that are fundamentally changing how multinational revenue is tracked. When I look at this horizon, I see strategic business insights that should dictate market entry.
Wait, how does an OECD reporting initiative dictate market entry?
Well, when a company evaluates entering a new territory, the commercial viability assessment usually focuses on obvious metrics, right? Customer demand, logistics, real estate.
Standard business development.
Right. But the tax function now has the earliest and most detailed visibility into the local indirect tax infrastructure and the complexity of that target market. If a country is about to implement a highly aggressive, deeply embedded CTC regime that will require a massive overhaul of the company's internal billing systems,
which is incredibly expensive.
Exactly. That knowledge should directly influence the commercial viability assessment. It fundamentally changes the cost of doing business there. The tax leader's intelligence should dictate whether the company enters the market at all, or at least how they structure their pricing.
Corporate expansion. In reality, regulatory anticipation is about raw organizational survival and cost control for the markets you are already in.
Anticipating a mandate isn't strategic.
It's structural foresight, not expansion strategy. Let's go back to those ERP migration design sessions. It takes immense time to build these compliant systems. When a new e-invoicing mandate is announced for a country where you already operate, the global head of indirect tax has to translate those emerging requirements into architectural investment decisions a minimum of 18 months before the mandate even takes effect.
18 months just to prepare the systems.
Because you have to untangle years of legacy spaghetti code in your billing systems just to ensure the data that government now demands is actually being captured. You are managing ERP upgrades, adjusting middleware, running endless testing cycles with government servers.
Right.
If you are doing this right, you are building a competitive compliance capability. Organizations that are architecturally ready when the mandate goes live absorb the cost of compliance at a fraction of what reactive competitors pay.
The reactive competitors being the ones who wait until the law is passed to even look at their software.
Exactly. The competitors who wait are perpetually scrambling. They are managing operational crises, their shipments are delayed, and they are paying premium, exorbitant emergency rates to IT consultants to patch their failing systems at the 11th hour.
Yeah, it's a mess.
The paramount value of the tax leader here isn't telling the CEO where to expand. It's saving the company tens of millions of dollars in reactive compliance costs and lost revenue through superior architectural foresight.
I see why you think that, but let me give you a different perspective on what you literally just described. Absorbing costs efficiently and deploying capital carefully ahead of mandates, that is ultimately a strategic financial play. You're making my point for me.
How is that making your point?
Because when you build a system that outpaces competitors and protects the bottom line, you're proving that the role has transcended isolated tax compliance and is now driving strategic enterprise value. And let's connect that directly back to the CFO's absolute top priority, the working capital conversation.
Working capital optimization, the perennial holy grail of the finance department.
Yes, and let's look at the mechanism of how tax impacts it. VAT represents a massive working capital variable for any multinational. Input VAT generates refund claims from the government. Output VAT creates payment liabilities.
Basic accounting, yeah.
Right. Historically, Treasury teams manage this liquidity with incredibly low granularity. They look at 90-day historical aggregates, and they basically pad their corporate cash reserves just in case their tax estimates are wrong. That traps millions of dollars in cash that could be deployed elsewhere.
Because they don't trust the historical data. And frankly, they shouldn't.
Exactly. But in a CTC environment, the tax function has continuous, mathematically certain, real-time visibility into net, refund, and liability positions, jurisdiction by jurisdiction.
If the data orchestration is correct.
Yes, assuming the plumbing works. But if the global head of tax routes that real-time cash flow signal to the Treasury Department, Treasury can safely release millions in working capital. Why? Because they know exactly what the liability is today, not what they guess it will be at the end of the quarter. That is offensive value. That is why I maintain that the intelligence generated is the paramount asset.
But how does that real-time data physically get to the Treasury Department's dashboards? I mean, it doesn't happen by magic. It requires the tax leader to be an architecture sponsor.
Well, they collaborate with IT.
In most organizations, the data flows in one linear direction, from the billing system to the compliance platform to the government. Period. To do what you are suggesting, to optimize working capital, the tax leader has to literally design the compliance platform to export that validated transaction data into an analytical layer in a standardized format.
They have to build the literal physical data connections.
Yes! They have to write the requirements for the APIs bridging the compliance layer and the treasury systems. If the global head of tax does not have the architectural capability to specify those highly technical requirements to the IT department, all that working capital optimization remains just a theoretical fantasy on a whiteboard.
Okay, let me summarize my position here, because I think the distinction is really about where we place the ceiling of this role's potential.
The ceiling, sure.
My stance is that the global head of indirect tax has permanently transcended their defensive compliance origins. Yes, the technology layer is fiercely complex, and it absolutely requires governance. But by capturing the real-time transaction-level data that these CTC frameworks enforce, the tax leader is uniquely positioned.
Because of the data.
Because they are sitting on the richest, most validated dataset in the enterprise. When they step up to lead conversations on releasing trapped working capital, monitoring supply chain health via counterparty validation, and guiding strategic market entry, they are providing a level of insight that honestly no other organizational function can replicate. For me, the ceiling is C-suite strategic intelligence.
And my summary is that the foundation is the true evolution. The role's transformation is entirely structural. The modern tax leader must be, first and foremost, a technology and logic governor.
Even over strategy.
Strategy means nothing without execution. They must deeply understand both the esoteric regulatory nuances and how those nuances translate into executable code, orchestration layers, and vendor management. We are no longer doing corporate archaeology. We are ensuring the operational gears of the business keep turning in a real-time, transaction-blocking environment.
Right.
If you do not govern the architecture with absolute precision, the trucks don't leave the dock. And if the trucks don't leave the dock, well, there is no business left to strategize over.
What strikes me, though, is that despite our differing views on the primary value driver, we absolutely converge on one inescapable fact highlighted by our source material. The current corporate job description simply has not caught up with reality.
Oh, not even close.
Whether you view this leader as an intelligence generator or an architecture sponsor, the tax function has to be structurally rebuilt.
Completely rebuilt from the ground up. I mean, the legacy team structure of accountants manually reconciling spreadsheets at the end of the month, that's dead.
It is. It requires deliberate, aggressive organizational investments. You can't just mandate this shift in a memo. You need to hire data analysts and system architects directly into the tax function.
Yes.
You need to take your traditional tax specialists and actually develop their technology governance skills. And critically, the tax department can no longer sit in an isolated silo. It requires deep, permanent integration with IT, with finance, with procurement, and with treasury.
Absolutely. The capability development required to govern automated systems, evaluate technical vendor architectures, and route data flows is incredibly steep. Companies need to invest heavily in redesigning their teams for this new reality, or they will simply fail.
It really points to a profound shift in modern enterprise structure. It's not just about one specific role changing. It's about how organizations will have to physically redesign their internal walls to support this new mandate.
That's the real takeaway.
It is. We leave it to you, the listener, to decide. In a reality where the government is standing inside your digital cash register, does the most critical frontier for tax leadership lie in fortifying the architectural foundation or in extracting the strategic intelligence it yields?
A question that dictates whether a business thrives or stalls.
Indeed. Thank you for joining us on The Debate.